Secure your retirement with a Bitcoin IRA from Unchained. Right now, get started with no setup fees and enjoy your first year free. You can open a Roth and traditional Bitcoin IRA and even upgrade old forgotten 401ks and IRAs into tax-advantaged Bitcoin where you control the keys. Get started today at unchained.com/frontier. There's no better way to hold tax-advantaged Bitcoin for decades. That's unchained.com/frontier. And now back to the show.
When the price is going down, it's actually bullish. When the price is going up, it's bearish, right? The more the price goes up, the more bearish it gets because more people are in more profit and they're more likely to sell. And historically speaking, the more times I've done this, the more I realize that the narrative on Twitter is highly uninformative. Generally speaking, it is people playing off emotions, and it is people who, generally aren't qualified to have opinions on things, having very, very strong and very loud opinions, and they're usually the ones that get the most engagement. So if you look at, there's a metric we have called sell-side risk, which is only looking at the profit and loss locked in by investors. It looks exactly the same as options implied volatility. How the hell does two completely separate off-chain, on-chain metrics tell the same story?
This podcast is entertainment, not financial, tax, or legal advice. Views expressed represent statements of the speaker and their individual capacity, do not represent the views of Unchained, and should not be considered investment advice. Speakers often have personal, family, or business connections to Unchained, which may include direct financial benefits. Please see our disclosure at unchained.com/podcast.
Hey, everybody. Welcome back to the Bitcoin Frontier podcast. This week I have on James Check or Checkmate. Welcome.
G'day, Joe. Thanks for having me on, mate. Good to be here.
Yeah, absolutely. Glad to have you here. We're going to go through a number of good questions and good topics. I'm really excited for this one. I can go ahead and kick it off. What's one thing that you think most people are wrong about when it comes to thinking about the future of Bitcoin?
Oh, interesting. I think the first thing that people probably don't like to hear is that people sell. Now, this is one of these things that we've seen so much of it over the course of the last 6 months. And it comes in all different forms. Like, people like to put labels on things, right? As humans, we like to look for the obvious answer, and it's easy for us to reason about things. So GBTC, that was the first I think error that people had. They're like, oh, it's not really selling. It's like, well, a lot of that sell side were people who were arbitraging, right? They bought because the discount was going to close. That's just net sell side. That's a trade. There was a lot of those people. There's a lot of bankrupt estates. There's a lot of, people who've been in a bad trade. They just need to clear out those books. So a lot of GBTC was actually long-term holder sell side. It wasn't the majority of long-term holder sell side. So even though it was significant, some of those funds would have rotated. When we look at the actual, when we look on-chain, I love on-chain data because ultimately you can see the truth. Now, every single time Bitcoin has had a run at the previous all-time high of the last cycle, you get lots of long-term holder spending, you get lots of realized profit, and these are things that you can't dupe. A coin can only be long-term holder if it hasn't moved for 5 months, and it can only be in profit if it was last moved at a much cheaper price. Now, yes, some of those coins is some guy doing a wallet consolidation. Some of those coins is some guy just putting it into a different wallet. Most of it isn't. Now, over the course of the last 6 months, we've seen, at some points in time, hundreds of millions of dollars of long-term holder profit taking every single day. So when people are saying, hey, it's price suppression because of ETFs or futures markets or Wall Street or whatever. It's like, guys, there's a whole bunch of guys from 2013, from 2011, from 2017 who are taking massive profits, and that's okay. This is what happens, right? The fact that the market didn't go down more than 25% short of the yen carry trade wick, guys, that's the signal. The fact we didn't go lower amidst that sell side, that's the important message. It's not price suppression.
Those are some great points. I'm curious, did you happen to watch the podcast with Saylor and Saifedean talking about Bitcoin banking and how that might play out? Do you have any thoughts on that if you happen to have seen it?
That's actually on my radar of things to listen to. I'm going to have a listen to that today, actually. So no, I haven't. But in terms of Bitcoin banking, my personal view, and I actually spoke with Alex Thorne yesterday, and one of the topics we talked about was just are we going to go on a full Bitcoin standard? My opinion of the Bitcoin banks, the Bitcoin standard, hyper-Bitcoinization, there's what I would like to happen, which is that we go back to a sound money standard, and then there's what I think is going to happen. Right, so let's talk about what I think is going to happen. What I think is going to happen is we're going to have a dual standard where you have Bitcoin, you have collateral, Bitcoin, gold, real estate, whatever. Bitcoin is a fantastic, pristine collateral. So you got collateral and you got fiat. You need to borrow money that is faster, cheaper, shitter, worse, Gresham's law. You need money that is borrowable. I don't want to borrow Bitcoin because I'll never be able to pay it back. I know what Bitcoin's going to do. It's going to be super hard to pay back. Whereas fiat, I know I'll be able to pay that back, right? It's going to get worth less over time. And in many ways, you kind of need that dual standard. I think that's actually a healthier system. And I also think governments will never let go of fiat currency. So you kind of have that dual standard. On the Bitcoin banking side, I also believe that we will see Bitcoin banks. And the reason that I say this is not because I don't believe in self-custody. I'm an avid believer in self-custody. I think everyone who wants to do it and can do it should do it. If you can drive a car, you can self-custody. However, having spent enough time now observing the reality of markets, the reality of products, 95% of people in the world just aren't up for it. They just, we can hammer them and we can tell them, we can say, please, you got to do it. They're not going to. So I think that the reality is a lot of people, they require banks, that whether it be at an institutional level, they need that custody arrangement, they need that relationship. At an individual level, people don't want to have to bury their seed phrase in their backyard. People aren't responsible for things. That's just like, it's an unfortunate reality, but it is a reality. So I think Bitcoin banks are going to be a major thing. I also think that they're a key level of how this stuff scales. And I really like Lynn Alden's framework for the ETFs. The ETFs are an API for TradFi into Bitcoin. Banks will be an API into Bitcoin. Self-custody is an API into Bitcoin. These are all different ways that people can connect to the Bitcoin network. We will have a diverse, and we'll have heaps of these. And the best analogy, I think, is that the US dollar is the most managed currency in the world, and yet it's still the preferred currency for buying cocaine off the street. It serves this dual purpose where it lives in its respective domain. And even though it's controlled over here, it may not be controlled over there. And I think Bitcoin's destined for a very, very similar path.
Yeah, you brought up the ETFs kind of being a wrapper away for the traditional financial system to kind of get into Bitcoin. Recently, options have been enabled or are approved, not enabled quite yet, I guess, but approved for Bitcoin ETFs. Do you think that that's going to have a big impact on the Bitcoin market or not really?
No, I do actually. And I as of yesterday, I did a masterclass on options for my subs because a lot of people have no idea what options are. They're a fairly exotic instrument, but they are also the most prevalent, right? They're really, really, I think the options on the Bitcoin ETFs or options on Bitcoin that are available for Wall Street, I'm of the view that that's probably the killer app for Wall Street guys. And ultimately, Bitcoin is more volatile than other assets, although technically it has a similar volatility to the Mag 7 at the moment. So, but that volatility capture, the ability for miners to hedge themselves, the ability for hodlers to do covered call strategies and actually earn an income. There's so many different strategies, products, things that these options are going to open up. I think they're absolutely enormous. They will have a notable impact on the volatility profile. They'll also have an impact in terms of where is the max pain level? We see that the S&P 500 tends to trade with options as a very, very important structure, right? Where is the max pain point for both sellers and buyers of those options? I believe that we'll see the same step into Bitcoin. And the other thing that's really important here, if you're trying to allocate, Michael Saylor levels of capital, right? Billions of dollars. He's basically short dollar, long Bitcoin. Other institutions don't quite have that kind of leeway to just go one single strategy. They need these deep liquid options markets to take a $100 million position in something and then be able to hedge it, right? They can actually hedge their risk on the way up. It allows them to hold the spot in much larger size. So it's one of these maturation processes. Futures and options, particularly options, they give big money more, literally, options, more optionality, more capacity to hedge risk, which allows them to allocate more money to the position. So you get this kind of interesting world where it's it's part of the maturation process of Bitcoin as an asset.
Yeah, that seems to make sense with me as well. Are there any metrics, whether this is on chain or macro or even models that people commonly talk about that a lot of people still think about or rely on that you think are completely worthless? I'm sure there's an infinite number of metrics or models, but are there any that are very popular that you're and this could be on-chain metrics, this could be models, it could be whatever, that you're like, people need to stop looking at this metric or model?
Well, look, there's a lot of answers to that which are pretty obvious, right? You could go down things like stock to flow models and all that. But let me give you a bit more of a nuanced answer, something that people may not have kind of thought about. More often than not, people look at the realized price. And you've probably all, if you've seen any kind of on-chain analysis, realized price and MVRV, quite often people interpret this or realized price as the average cost basis for investors. That's actually the incorrect framework. The problem with the realized price is it includes all of the unrealized gains held by Satoshi and lost coins. So let's think about what this means. When MVRV, which is a ratio between price and the realized price, is at 1, we consider that to be at break even. But the problem here is that Satoshi, back in, I think it was January last year, when MVRV was 1, the market is at break even. Satoshi was actually up like $38 billion in profit. So how do you get to break even? $38 billion of losses are held by active investors from the last cycle. Now, which of those groups do you think is more relevant for market structure? It's probably not Satoshi. Unless he starts moving his coins, I don't particularly care how much profit he's in. So in many ways, the realized price underestimates where the true cost basis is. And Dave Puell and I did a very detailed study called Coin Time Economics, like 120 pages of like really exploring how we can solve this problem. And ultimately, what we found is that there is actually another model out there. We adjust the realized price using coin days, which is how long coins have been held. The short answer is that the longer a coin is dormant, the more we discount it. We don't care about that coin as much. I care about coins that are mobile and liquid and moving around the system. Now, when we come up with that price model, we basically found that the realized price is actually technically it's the average cost basis per unit of Bitcoin. Whereas we found a model called the true market mean, which is the average cost basis per active investor. And active investors is far more useful. And this model, we call it the true mean price. It is like statistically speaking, the long-term mean and the long-term median is 1. The Bitcoin market spent 50% of its days above it, 50% of its days below it. It is the ideal mean reversion model. Now, it's currently about 47,000. So if you think about what that means, is if it's the middle, it's kind of where the market gravitates around. It oscillates around it. And it also defines bulls and bears on a macro scale. So that's one model that's probably a little bit sideways to your question. But, a lot of people look at the realized price and think the average cost basis. Actually, we should be looking at the true market mean, which tells you that people actually go underwater much, much higher up in the stack. So in the price chart. So it just kind of gives you that level of sensitivity that you don't have to get down to the realized price to be in some serious investor pain. It's actually much higher than that.
Oh, yeah, it's very interesting. I guess if I have seen that chart, it's been a while, so I'll be curious to find it. Is that like on your website or something?
Yes. No, you'll find it in a few places on Check on Chain.
Okay, very cool. As we're like going into, potentially or a continuation of the bull market that's kind of been going on for the last, 2 years or so, what are key metrics that people can be watching to kind of know that, hey, like the market is getting extremely overheated right now, and then they can decide what they want to do after that. But what would you be looking at to try to identify a top in the price of Bitcoin?
That's a great question. So my framework for these things is people say, "What's your price prediction, and when do you think it's going to happen?" And I see a whole bunch of people being like, "Oh yeah, December 2025, it's going to be this price, and I'll sell everything, and I'll be happy." And I'm like, based on what? So my approach is, I don't care what the top price is going to be. I have no idea. No one does. I have no idea when the top will be. No one does. What I do know is the mechanics and the behaviors that will put a top in. So the way I like to frame it is, show me when a whole bunch of long-term holders are selling coins at an enormous profit, and then I'll look at the price and I'll look at the calendar and I say that probably looks a bit more like the top. So in terms of metrics, try to think about what a top is. A top is when demand is oversaturated by supply. People are selling more coins than is flowing in. Now, demand in a bull market, and ultimately demand all the time, is the ultimate variable. But in a bull, we don't know who's going to hit the green button, when, for how much, and for how long, right? So these are variables that we just can never know, and try to pretend that we know is a fool's errand. So instead, think about Newton's third law. For every action, there's an equal and opposite reaction. For every seller, there's a buyer. For every buyer, there's a seller. So you can indirectly measure demand by looking at sell side supply. So in terms of metrics that I'll be looking for when we start to get into that, toasty overheated range, you'll look at realized profit. I want to see coins that were acquired at 20,000 being sold at 120 or 200 or 400, whatever the price is, doesn't matter. So I want to see lots of coins, lots of them, realizing huge profits. I want to see lots of coin days. That's a holding time being expelled out of the market, old supply coming. I don't care about coins that were bought yesterday. I care about coins that were bought 2 years ago. Now, what you'll generally see is that you've got realized profit by long-term holders and spikes in realized profit by short-term holders. Basically, every man and his dog who's up is selling. So they're the kind of metrics I'll look for. You can look at things like MVRV, AVIV, all these different ratios of like people being in profit, unrealized profits. When too many people have like fat green numbers in their portfolio, and this is another thing that a lot of Bitcoin hodlers don't like to hear, but just because you look at your portfolio and you go, yeah, hodl, doesn't mean that some other guy doesn't go, I could probably get a house for, some portion of this. People do sell, even if it's not you, some people do sell. And the idea of what I look at in on-chain data is looking for when people are selling who may not be me. It may not be my price. It may not be my time to get off, with a portion of my stack, but people do sell. I want to see when they are selling, and I want to see when they're selling in sides. So old coins on the move, lots of profit getting taken, unrealized profit being through the roof. People are really, really up, feeling really, really good, and they're selling a lot at the same time.
In this frontier moment, James is talking about how difficult it is to time market tops in Bitcoin. But he does say that all major market tops have been marked by an increase in long-term holders selling. One of my favorite simple metrics that illustrates this is the HODL waves. The 1-year HODL wave shows the percentage of Bitcoin that hasn't moved in over a year. When the percentage is high, it means most people are holding their Bitcoin. When it's low, it means more people are selling. Market tops often align with these lows as holders start selling off. This is a simple way to visualize what Checkmate is explaining. During bull markets, long-term holders tend to take profits, which can signal a market top. And now back to Checkmate.
Right, and when you've got all those combinations, who's on the other side of that trade? People who are buying their first Bitcoin at a very expensive price because they believe the narrative on Twitter. Watch out below.
Yeah, that seems like a pretty fair assessment. I guess, so you're basically saying you would take almost like kind of like the Fed, like you would take a data-driven approach. Like you don't know, for example, in the Fed's, perspective, they don't necessarily know when unemployment would spike, but once it does spike, that's when they know that they would really need to cut interest rates a lot and stimulate the economy. Whereas like you're kind of like, I don't know when a lot of these OG holders are going to start selling, but when they do, that's probably a sign that things are getting out of control.
Exactly. And it's one of those things where I've got certain levels, like you can change some of these like indicators, right? Let's say that you've got MVRV, just a good example. When it's like 2 standard deviations above its mean, you can actually back calculate a price from that. So in other words, you can say, well, what price do we have to get to before hodlers are up so much that's historically speaking, they start taking profit. And by the way, this works in bear markets as well, because hodlers can carry enormous unrealized losses, right? They can just have a red portfolio and they don't care because they're price insensitive. So you kind of look for what is the deviation to the downside. All the speculators are gone. There's no one left who doesn't believe in the asset. And you can start to say, well, if there's only the hodlers that remain, I kind of want to be in the trenches with those guys. So then if I'm in the trenches with those guys in a bear market, show me when they're leaving in a bull, because that's the opposite. And it's just this like big pendulum that swings from hodler dominated to speculator dominated. And you want to watch out for periods in time when the speculators dominate.
Yeah. Another thing that I think, Twitter in particular is kind of fallen to is like people are extremely bullish when the price of Bitcoin is ripping. And then a lot of people are like bearish when the price of Bitcoin is going down, and people kind of play on each other's emotions for engagement. And I feel like you've done a phenomenal job over the years of like not falling to that. How have you, protected yourself from like not buying into the engagement hype and kind of being more unbiased with your analysis?
Yes, I love seeing the narratives on Twitter not play out in the data. It's one of my favorite things about having access to this stuff, because it's so clear that the narrative on Twitter. So as a good example, we've been in a downtrend for 6 months. When the price is going down, it's actually bullish. When the price is going up, it's bearish, right? The more the price goes up, the more bearish it gets because more people are in more profit and they're more likely to sell, and vice versa to the downside, right? The lower it goes, the more the bulls can actually stack sats and load up and, put a floor in. So the lower it goes, the more bullish it is, the higher it goes, the more bearish it is. So in many ways, it's a little bit about experience, right? You spend time in markets, you kind of see how they operate. You'll often hear the contrarians tend to do quite well because they're kind of looking at the flip side, but, timing is obviously important. Ultimately, I think that the data that we have available, it tells its own story. And the amount of times that I've looked at the data, looked at the narrative on Twitter, and they don't gel, right? So, and historically speaking, the more times I've done this, the more I've realized that the narrative on Twitter is highly uninformative. Generally speaking, it is people playing off emotions, and it is people who, generally aren't qualified to have opinions on things, having very, very strong and very loud opinions, and they're usually the ones that get the most engagement. So another tool that I've used certainly is and I say this openly in all my newsletters, I say, I'm not going to predict price because I got no idea. None of us do. And anyone who tells you they know what the Bitcoin price is going to do is lying to you. They have no clue. None of us have any idea. What we can do is prepare. So the way that I like to frame these things is I don't predict price, I prepare for it. We could have gone down to, I mentioned 47,000 before. My subscribers have been looking at that 47,000 level as a point where if we did get down there, the sentiment on Twitter would have been absolutely horrific. I mean, it was bad at 50, let alone at 47. It would have been so dire. And yet, that would be the exact level where I would expect the bulls to mount the strongest defense. The closer we got to 47K, the more bullish I became, right? The further away we got, the more I was like, look, chop consolidation, this kind of consolidation process, we probably needed 6 odd months to kind of cool down that 18-month uptrend. So I was like, look, the higher we go, the less bullish I am in the tactical sense. Always bullish Bitcoin long-term, but the closer it got to 47, the more bullish I was willing to step in and actually do something about it. So yeah, at the end of the day, I'm not trying to predict the price. I'm trying to prepare because in markets, it's like a tide. You can't swim against the tide. You can't change the tide. You can't change the weather. All you can do is say, well, if this happens, what will I do? That's the only thing you have control over. If we get down to 50, we're getting close to 47, what am I going to do? I'm going to stack sats. If we get up to 70 and we're not quite ready to keep going, what am I going to do? I'm going to not buy, right? That's my decision framework. And I think about that before it happens. So then I have a framework so that when it does happen, I'm not waking up going, holy shit, what do I do with this 47? Oh my God, what do I do? It's like, I know exactly what I do. I stack sats.
When it comes to this current Bitcoin bull market, or even just Bitcoin bull markets in general in the past or in the future, is it better if the price of Bitcoin kind of like has a slow grind up and then kind of has like a parabolic flow off top? Or is it bad if the price of Bitcoin just soars really fast and all of a sudden a lot of, old holders sell? Like, is there kind of like an optimal zone of slow grind that would enable Bitcoin to go as high as it possibly could? Or does it not?
Fantastic
really
question. No, it absolutely matters. To kind of put let's use some case studies here. The current market structure, in my opinion, is very, very similar to 2019. Very similar. Although 2019 was more bearish. There was a lot more violent downside. This has been incredibly structured and it's been choppy, but it's been very, very structured. So we have completely reset investor expectations. Now, what do I mean by that? People are used to 60,000 now. They're not expecting 30,000. This is not like something that people are kind of budgeting for. They're planning for, hey, if it goes to 50, I'm in, right? I'm going to step in and buy that. So in many ways, investors have become acclimatized to this 50, 60,000. Take the exact same price range back to 2021. Super violent, 50% swings to the downside, back to all-time high, and then into a nasty bear. That was really hard, right? In terms of investor getting just whipsawed around, that's brutal, very unstable. This market structure, very, very stable. Now, once you get into what I call the euphoric zone, right? And usually this comes in past cycles when you bust through all-time high. We had like a tiny flavor of that at the 73K peak, but that's it. It was just like a tiny little taste. Once it really gets going, and you probably remember this and notice this from 2021, it's exhausting. When a bull market is in full raging swing, you get like 12 months in and you're like, God, I love this price going up, but I'm tired. that's a sign. That is, when you get that feeling, just start looking at too many people taking profit, because that's usually when bull markets get exhausted. Now, the more it just kind of stair steps higher and just keeps doing this like slow, very, very, very constructive, it can essentially stair step like that indefinitely. Now, it won't do it indefinitely, because at some point it's going to go parabolic and people get super excited because they just see this is easy money. I can't lose. So these things like naturally resolve themselves. People lever up and blows up. So nothing is ever going to keep going in one direction. But where we are at the moment, this like very stable stair-stepping pattern is extremely, I mean, if we do this for another leg, the more it does this, the higher those price targets can go, because we don't enter that euphoric phase. Once we enter the euphoric phase, you'll know about it, you'll feel it, you'll get tired, check realized profit, because I guarantee you that people will be selling into it. And then you start going, maybe this is unsustainable.
Yeah. One of the things I think that Saylor and Saifedean talked about in their podcast was, I think when Saifedean sat down with Saylor back in 2020, I believe, or 2021, Saylor believed that Bitcoin would not fall 80% or more, or roughly about 80%. And then, of course, it basically did into 2022 and 2023. Do you think that will happen again? Like, will we have another 80% drawdown or worse, or no?
Good question. So I would say I would err to the side of maybe not. And the reason I say this is, think about what it took to give us I think it was 75 or 80 was the drawdown 22. Think about what it took to do that. It took interest rates going from 0 to 5.5 in the most aggressive in history, right? Which every asset suffered from. It took multiple deleveragings of Luna, who just market sold 80,000 Bitcoin like in 3 days. It took Three Arrows Capital, who blew up several billions of dollars of investor capital. It took GBTC, which had absorbed billions of dollars of toxic, like 660,000 BTC that couldn't get out. People had to hedge that elsewhere, right? Whether in futures or whatever else it was. It then took FTX to implode and not have the coins in the Think about the scale of how nasty that was, and how much fraud and how much just like bad behavior it took to get the 80. Now, of course, we may have an 80, right? I don't know, but I think it would take a lot, right? Now, something that, and we're nowhere near this yet, something that could create some of these kind of things. We're seeing, some miners are putting more Bitcoin in their balance sheet. Historically speaking, miners are very pro-cyclical, and that means that they hodl on the way up, they don't sell enough at the top, and then they sell in distress at the bottom. There's a bunch of companies would put Bitcoin in their balance sheet. We're very, very, I don't think Saylor is going to be there, but not every CEO has the stones that Saylor has, nor the shareholder cap, the ownership rights. If we see just a plethora of zombie companies seeing Bitcoin as their escape valve and they start plowing into it, yeah, we'll get an upside, but I suspect that they'll be pro-cyclical on the downside. So look, as it stands today, we have a relatively unlevered market, relatively speaking. That's a good sign. And if you just kind of compare the scale of it, and this is a working thesis I have, it's not fully formed, and it's still kind of just like an idea, but I have this idea that everyone's looking for like the classic bull bear cycle, 4 years, the ups, the downs, like all the classic pattern, the 85 down. I have this working thesis that what if there is a time for the market structure to change, it's now. And what if we just had a miniature bear market, right? There were certainly some characteristics. What if people just lose track of where we are? Where did the bull market start? Did it start when the ETFs went live? Did it start when FTX blew up? Did it start like if we rally from here? Is it now? Like, where's the bear? Like, people just kind of lose track of, what if they're waiting for that 80% drawdown and we pull back 45 and then away we go, right? What if people get left at the station because they expect classic patterns to play out? And if there's ever a time for it to break, it feels like now is probably about right. People said that Bitcoin could not rally during interest rates being high. They're 5.5%. Bitcoin's pretty much all-time high. So there's a lot of things that are twisted and chopped around that could disorient people moving forward.
Yeah, I feel like that was one of the biggest kind of knocks of like traditional finance types, where they would say like, oh, Bitcoin is obviously a ZIRP, zero interest rate phenomenon, and it's been going on for 14 years because the Fed's been easy money for so long, and then all of a sudden they raised to 5%. Commercial real estate is kind of imploding. It was like the worst year for bond, like long duration bonds, like in economic history pretty much, or at least US history for a very long time. And then all of a sudden Bitcoin just like kept going higher. So it's
it's at the top of that. You see that grid float around all the time where it's like asset performance, and Bitcoin, it's green, 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 red, green, 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 red. And it just shows that it beats every other asset. It's like, guys, that's ZIRP and then non-ZIRP, and it's at the top of the rankings again, 2 years in a row. We're starting to get a bit of a message here.
Agreed. When you look at your like on-chain analytics metrics or various models, does that like change? And you don't have to answer this, I guess, directly for you personally, but you can if you want. But does that change like the way that you allocate capital? Like do you sell Bitcoin at the top? Do you DCA less? Do you DCA more during certain times? Or how do you think about using the metrics and actually making actionable decisions?
Oh, absolutely. No, I'm more than happy to share my approach here. In fact, I built a price chart recently because I felt that for a little while now, I felt that we're getting very close to the end of this chopsolidation for probably about a month, right? So a month of eating my words. I'm like, we're getting real close, right? This market probably wants to go. My macro bias was back to the upside. But through this process, my general framework, and in my newsletter, I try to be very open and honest and transparent. So I built a price chart that shows all of my personal DCAs, and the newsletters that I was writing at the time and kind of what the framework was. My general approach. So for me, I don't sell Bitcoin. I'm essentially a hodler for now. I've been in this market since 2017, but really kind of understanding and stacking Bitcoin as like I get it, 2019 onwards. So for me, I've kind of gone through a couple of cycles, but it's not my time yet, right? For me, at some point in time, 5 to 10% of my stack I will use to improve my life, get a house deposit or whatever, just, capital to improve my life, and you hang on to the rest. That's kind of my plan, but 73K, it's not my price. 100K probably isn't my price, right? For 2013 guys, this could be getting close to their life-changing money, right? So some people will have their exit ramp. It's not for me yet. So the way that I use on-chain data is I don't like to buy when people are taking lots of profit because the probability is we're going to set a local or global top. I do like to buy when the people who didn't listen to that first point bought high. I want to see when they sell low, and I want to buy their blood and we can see this in on-chain data very, very clearly. We talk about short-term holders. They will always buy the euphoria. They get very excited. They look at the narratives on Twitter. They don't realize that there's a bunch of smart money selling to them. They buy high. We see the price collapse down. They realize really, really fat losses, and they usually all do it at the same time in this like big spike of loss. I step in and buy there. And the way that I try to frame this up for my subs is I go, look, we don't know what the future holds. Let's imagine the Bitcoin price was destined. No matter what we do, the forces of power wanted it to go to 40,000 at some point. I would rather have bought my sats 56, at 53, at 50, during the yen carry trade at 49. These are all the levels where most of my DCAs were during those big waterfall. Because even if we do go to 40, that could just be where the divine powers want Bitcoin to go. I would rather have sats from 50K and 53 and 56 because I'm only down 10% or 20, or 20 at most. Guys who bought at the top, they're down 40 or 50, right? Whatever that price level is. So it's about like how much pain can you withstand? I would much rather be down 5 or 10% because I don't care, right? It's another day in Bitcoin. People who are down 30 or 40%, they're the ones who really, they feel the pain, their sentiment gets wrecked, and they end up selling in pain at the wrong time, usually right before the market wants to go higher again. So ultimately, right? And if you do that, just imagine that process. If you're buying at 50 and not at 60, or you're buying at 53 and not at 65 on these kind of rallies, you've improved your buying. You've got 10, 15% more sats on every single stack. Compound that over your entire time in Bitcoin. It's tremendous, right? You're adding a 10% benefit to your overall approach. And these are not hard tools. Like you can literally do this with 2 metrics. So at the end of the day, it's looking forward. Don't buy when people are selling and taking profit. Try and buy when those people sell at a low and take a loss. Just switching to that approach, it's kind of like an improved DCA strategy. And for me, it works fantastically well. And I think I'm very open in sharing how I'm thinking about when those events happen.
Yeah, that makes a lot of sense. And I guess you are right. Being down 10% in the world of Bitcoin is kind of a typical
another day. Yeah, exactly. And that's the thing, right? It's like that's only for your most recent buys. And most people anchor to their most recent buys, even though you've got coins from 6,000. If you buy at 70 and then it goes down to 60, it feels shit, right? It feels shit. But imagine if you had bought it, 55 and it goes down to 50. Okay. I don't mind. That's okay. I can deal with that.
For sure. We definitely got a number of people that submitted questions, and I kind of want to start running through some of these. We covered a couple already, but there are some other good ones too. One is about the whole concept of entity adjusted, and basically the person wants to know, like, how accurate is it really? Like, you can, I guess, always create like unique scenarios where you have a wallet and you deposit, a Bitcoin or 10 Bitcoin or 0.1 Bitcoin or nothing. It generates a new address, you deposit another one, and you do this 50 times. Like, would that, I guess, and you never spend from those 50 addresses. I guess in that unique case, that would be 50 specific unique entities. How accurate is the whole concept of entities? And like, are there like critical flaws or no, in your opinion?
This is a fantastic question. It's one of those nuanced ones. So let me kind of step through a couple of scenarios to help illustrate it. Entity adjustment is a classic example of right tool for the right job. So let's start from the ground zero. If you and most of the data that I use on my site is non-entity adjusted. Basically, it's just looking at the chain itself. So what I found is that I ran a series of studies, and there's two types of metrics, generally speaking, in Bitcoin. Metrics that describe coins that are not moving, supply, hodl waves, coins that are held, MVRV. And then there's metrics that describe coins that are moving, volume, realized profit, SOPA. They're kind of metrics that describe stationary, mobile. When you're looking at entity adjustment, stationary metrics, you maybe get 5-10% of like a general impact. When you look at spending metrics, you can get 60 to 80% differences, very, very significant. So it works much better on the spending type metrics than the non-spending metrics. Now, going one step further, in my opinion, entity adjustment and these kind of things is much more useful if you are looking specifically at exchanges. You want to filter exchanges out. Show me hodl waves without exchanges. Show me volume in or out of exchanges because I want to look at, buying and selling pressure, that kind of thing. If you're looking at the broader market and you just want to see Bitcoin as sentiment, in my view, you don't, and on daily resolution, like you don't, I don't think people need to go, most people, if you're doing algorithmic trading and stuff, yes, you need finer resolutions. But for most people, right, hodlers, you probably only need daily resolution, and you're getting 85 to 90% of the signal. And that's where I kind of overlay my expertise. Like, I can mentally account for the remaining 5-10% fairly easily, right? When I see a big realized profit spike, I'm like, oh, well, that was Mt. Gox moving their wallet. I'm going to ignore that. It's not a real signal. Carry on. So for my style of analysis, I don't particularly need entity adjustment. If you're looking at buying and selling pressure, if you're looking at exchange balances, if you need to correct metrics for what you don't want to see Binance churning around coins, because by the way, coins going in and out of exchanges or transferring inside exchanges is somewhere between 80 to 90% of volume at any day. So it's very, very significant. And that's why it has such a big impact on those spending metrics. Now, there's another layer to this. So exchanges, absolutely. If you need to look at exchange activity, then entity adjustment is not only required and very accurate because we can profile what Binance and Coinbase do. They're always changing their wallet behaviors. But generally speaking, with a competent data science team, you can track these things in great detail, and they're very accurate. Where I would not recommend people worry about entity adjustment is trying to track whale watching. I cannot stress enough, I have not seen any data ever that is accurate enough to track whales. People keep looking at, oh, look, this 1,000 wallets, like, does it include exchanges and ETFs or not? Does it include custodians or not? Until someone can truly filter that out and say whales that are not those entities and whales that are, it's so noisy. People love to look at Mr. 100. It's an exchange, guys. If you think Mr. 100 is buying, that's actually someone selling because people are depositing, right? Your interpolation is 100%, 180 degrees wrong. But more importantly, because you don't know what the entity is, any conclusions you draw are just false because you don't know. So, and the last one, actually, let me talk about the DCA hodler. Now, contrary to whale watching, which I don't recommend people look at big wallets because there's like 2,000 of them. Most of them are exchanges. And because there's a small number of them, they will also break down their coins into smaller denominations. It's a nightmare. Don't do it. Shrimp and retail size, like people less than 100 BTC, they tend to behave in a big amorphous blob. So yes, you're correct. If you're a DCA hodler and you don't do privacy best practices and you withdraw to the same address, yes, that will be one entity. If you're a DCA hodler and every month you withdraw to, 0.1 Bitcoin or 0.05 Bitcoin, whatever it is, if you withdraw them to separate addresses and you never combine them in a UTXO, that is one entity, one entity, one entity. So yes, many, and this is why these measurements of like how many users there are on chain, if you just look at the number of wallets, it's massively overinflated, even if you do it on an entity basis, because it looks like, a DCA hodler who does it once a month, there's 12 entities, but it's one active entity in that month. So you can look at active entities, and that's going to be a correct reading. Total entities, you're going to be off by a factor of 12, right? Or a multiple of 12. That said, even though you're a hodler and you may DCA 0.05 Bitcoin once a month, your total stack over multiple years is going to be more than one Bitcoin, right? If you could stack that much, you may have more than one BTC, but you're going to behave like the shrimp, the massive shrimp. So shrimp, small retail holders, we tend to behave in a big blob. We all do the same thing. We all DCA the same way, right? There may be 4 or 5 different ways we do it. We all do the same shit. So at the end of the day, you can kind of look at that big blob of people and say, well, I don't really care how many entities are in there. Show me when a bunch of those retail holders are buying or selling, because that's information.
Yeah, it's definitely fascinating. Do you think like with the introduction of ETFs, that's going to massively change on-chain analytics or no, it's kind of the same as exchanges?
Yeah, no, good question. So I've been waiting for on-chain metrics to blow up and die. And I wake up every single day being like, all right, what's broken today? And I continue to find that it just keeps plugging along. And I think my favorite chart that I've ever discovered in all of my analysis time is a metric called SOPA, which is the profit and loss locked in by investors. It is identical to funding rate. Why? How can you? And also, if you look at, there's a metric we have called sell side risk, which is only looking at the profit and loss locked in by investors. It looks exactly the same as options implied volatility. How the hell does 2 completely separate off-chain, on-chain metrics tell the same story? It's because when you're doing a survey or a population survey, you don't survey 100% of people. You survey a statistically significant subset and you extrapolate. What is on-chain data? You are surveying a statistically significant subset of the entire Bitcoin network, right? Filtered for exchanges or not, and seeing what kind of profit or loss they're locking in. If you're looking at exchanges, for example, when you deposit your coin to an exchange to sell it, for example, what you're sending from your cold wallet to the exchange locks in realized profit. Binance receives it and then they put in their hot wallet like 0.5% in price difference. So like your spend was most of the realized profit. Theirs is just like kind of chopping it around in the hot wallet. It's irrelevant. It doesn't matter. Realized profit there, it doesn't matter. So the signal is still extremely clear because you're surveying the hodlers. You're getting the story that the hodlers are telling you and you extrapolate, right? So ultimately, it's all about sentiment, sell side, funding rate is sentiment, and sell side and buy side. You combine all these different elements. Now, on your question with the ETFs, we've seen this movie with ETFs a couple of times in the past. ETFs are basically a pool of coins that go in somewhere and then they trade around inside. That's what Binance is. In 2017, we saw a pool of coins go into Binance and then they were trading around shitcoins. Same thing. And we saw it in GBTC. Coins go in, they trade around on the inside, and that's like these are still supply sinks. On net, we still see the coins settling. So at the end of the day, the intuitive, like you would initially think, yes, if all the trade volume is in exchanges and all the trade volume is in ETFs, surely all these on-chain metrics will break. It's like if you survey 100% of all on-chain volume, do you think that might represent at the same time that a big hodler who's been around since 2013 is taking a big profit? Do you also think that maybe someone in spot exchanges is getting very excited by the narratives on Twitter and buying high? Yes. So you're surveying a population and extrapolating, and that's the best way to think about this stuff. So I wait for it to break. I bank on it breaking at some point. I'm yet to see much evidence that it's breaking. So until it breaks, I'll keep plugging along.
Yeah, you brought up an interesting point about the similarities between exchanges and ETFs. I had the thought recently where it's kind of funny how, historically people have been looking at exchange balances, seeing it go down and being like, oh, that's good. Bitcoin's becoming more scarce. And now we're looking at ETF balances and they're going up and people are like, oh my gosh, like this is great. Like funny? People are buying the ETF.
Yep. No, 100%. And at the end of the day, when I look at the ETFs, You can plot out what their average inflow cost basis is. Obviously not going to be the cost basis because people can buy and sell the shares on the NASDAQ or wherever it trades. So people can buy and sell the shares. That's not their actual cost basis, but the inflow cost basis, every time the market went below it, and this happened 3 times in the last 6 months, there was a burst of outflows and then a rapid inflow because people are buying the dip. It looks like MVRV. It looks like short-term holder MVRV. Short-term holders are doing the exact same thing that the ETFs are doing. Because when you survey Bitcoin holders, MVRV, and you extrapolate and say, I wonder if ETF investors have the same sentiment. We do, because we are all human beings and we all react to the same stimulus of fear and greed. It's what drives markets. So if you can survey the futures market and the on-chain market and the ETFs, and they all tell you the same story, which by and large they do, that's it. I mean, that's signal. That's signal right there. You've got 3 different populations that are telling you the same answer. Why would you bet against that? And the exchange balance is going down. Oh man, I put that in the bucket of whale watching. Stop doing it, guys, because the problem is that like when you actually factor in things like Coinbase custody and various, there's so many nuances. Exchange balance is going down does not mean they're going to run out of coin, because you know what happens when the price goes up? Hodlers sell. It's funny that, because supply always meets demand at the price, right? So yes, exchange balance is going down could mean some guy withdrew. It could also mean a bunch of coins went into a trading account or a custody account or a market maker. There's all sorts of things that people just don't factor in. So exchange balances, I would recommend for the average hodler, do not use them for signal because there isn't much there for that use case. There's a lot of signal for like institutions trying to understand the overall capital flows. A lot of institutional guys find a lot of value in it. And I can see why. For the average hodler who's trying to look at bullish and bearish means, exchange balances ain't it.
This is kind of a long-term, big picture question. I'm kind of curious to hear your thoughts. Maybe 20 years from now or so, what do you think a typical portfolio would look like? Like what percentage might be Bitcoin? And like an example, like today, a typical portfolio or maybe like a recommended portfolio would be like in the US, a majority sitting in the S&P 500 via a passive index fund. What do you think that looks like 20 years from now, in your opinion?
Yeah, that's a very good question, actually. And it will obviously be dynamic. In terms of a couple of like, let's just kind of benchmark ourselves initially. I think it was Fidelity. They put out a paper, it was a little while back, probably maybe a year or 6 months ago. And it kind of modeled out like what's a model portfolio. I think it would have been probably shortly after the ETF. So obviously they're biased towards that. And they were recommending like a 3%, right? 3% is like a portfolio allocation. I thought that the In Gold We Trust report, which is just a tremendous macro document, comes out every year. There was 2 insights many insights, but 2 of the big ones I pulled out for Bitcoin. First things first, they had a recommended allocation of like 3 to 5%, and they had Bitcoin in the document before silver, right? Goldbug's putting Bitcoin before silver. There's a couple of pieces of evidence there, right? It's right information. Now, if people were to allocate 2%, 1%, we've seen the Wisconsin Pension Fund. I think that was a serious piece of signal. They put 0.1%, I think it was, and that was 180 million. And they planned to get up to 1 to 2%. I think most places will start with that like 0.1, 0.5. They'll get to 1, 2. Bitcoin will do its thing and it will become 5 and they'll sell it down and then it will go back to 5. So I wouldn't be surprised. In 20 years, I think we'll be talking about like a 5, 10% allocation at most.
In this frontier moment, James is suggesting that in 20 years, Bitcoin could make up 5 to 10% of a typical portfolio. We will see how this all plays out, but in my opinion, that's a realistic but also potentially a conservative estimate. In Nashville earlier this year, Michael Saylor presented his Bitcoin 24 allocation model. For individuals, he suggested you have 5 potential allocation scenarios. The normie, as he called it, would be 0% Bitcoin. Someone very conservative could allocate 10% to Bitcoin. A Bitcoin maxi would allocate 80% to Bitcoin. A double maxi would allocate 100% to Bitcoin, and a triple maxi would allocate 100% to Bitcoin with an aggressive savings rate and some leverage. So if a lot of people start copying Saylor's maxi strategies, then maybe the 5 to 10% number is conservative. And now back to James.
Because I still believe that it will take a long time I don't believe that every investor is going to be a full-scale Bitcoiner. It's the only thing they hold. Because when that happens, for people to think about this, the reason that markets feel the most bullish at the top is because everyone owns it. Everyone's in. Who's left to buy? So if everyone is 100% allocated, there's only sellers. It's only sellers, right? So that's the way to think about it. I still believe it will be a minority component. Now, I think what's probably an even more important question is, what is the allocation relative to gold? And that, I think, is going to be a very interesting dynamic, because is it on par? Is it, whilst I'm not giga bullish on the US Strategic Reserve, I think that there's a long road for that to happen. The fact that it's being talked about at the same level as the gold that may or may not be in Fort Knox is very interesting, right? So is it at the same allocation as gold, right? Are we talking about a 3% versus gold's 10 or 30? Or are we talking, so look, the answer is I don't know, but I would say first things first, it will be higher than it is now, which is 0 for most people. It will start with the sub 1%, but I would not be surprised if it gets up into the 5% over the course of maybe the next decade, whether by its own price appreciation or by the fact that it actually starts to really prove itself and people get confident enough to allocate meaningfully to it.
Yeah, I did also want to ask you about gold, since you did bring it up. Like, gold has been hitting new all-time highs. It's been doing pretty phenomenal this year. Who do you think is buying gold in size and moving it up at such a historically aggressive pace for gold?
Yeah, so I think there's a lot of lessons we can learn from gold, because Bitcoin trades very similar to it. And what is that? So gold goes through very long accumulation periods, and then it reprices. This is typically how sound money assets trade. They have a large accumulation pattern, and then they reprice, they teleport to a new level. Gold's had a multi-decade, right? There was like 2020 through to 22 or 23 was this big sideways cup and handle style pattern. Arguably from 2012 all the way through to 2020 was another big, bear market consolidation period. And then it reprices. So in my view, gold is essentially, I really do believe it is the shifting of the global reserve status, right? Reserve asset, not currency. I think that USD will continue to be the global reserve currency. I think around the margins, particularly in the Eastern world, we're seeing, in Asia and the Middle East, I think we're seeing a lot more demand for gold as a treasury asset, because they've known that they need to probably release themselves a little bit from the US Treasury just for national security purposes. It's also, it is literally the same thesis as Bitcoin. It's a trustless asset. You know that gold's going to be there at the end of the day. So do these countries. And Bitcoin isn't big enough for China to put 5% of their reserves into, right? Gold is. So you're seeing this dynamic where I think there's a bid coming from the East. We've actually seen US ETF outflows for many years. I believe that's starting to turn back around. But it's kind of this very quiet bull market. It's a repricing event. I don't believe that gold comes back down from this. I think it over any kind of meaningful time frame, I think it heads much, much higher, because it's more or less an index on trust in the US Treasury. I think it's an index on emerging market growth as emerging markets. And I do believe they're probably going to have a series of good years. The yin to the yang, right? The G7 and the Western world's done very well over the last 40 years. I feel like the yang to that is that the emerging markets probably do a little bit better on a relative basis over coming decade. So as a result, their growth, gold is a preferred storing vehicle. In India, it's a preferred storing vehicle. In China, it's a preferred storing vehicle. I think Bitcoin will fall into that bucket as well. So I think the story that gold is telling us is actually telling us a leading indicator for where Bitcoin's going to go. It's hard to get your head around these numbers, but when you're seeing gold going up 3, 4, 5%, you've got to think about that. That's 5% on a $15 trillion asset. I think it's like 17 or 18 trillion. These are entire Bitcoin market caps over the course of a month. So these are very, very serious numbers. I think it is that sound money repricing event, and it's a function of trust. And, people want stuff that they know is going to be there in a decade's time.
Yeah, it's kind of, I guess, goes back to the whole concept of the buy pressure multiplier. It's like, if gold is going up by, trillions of dollars, I'm guessing that obviously doesn't mean people are buying literally trillions of dollars of gold. How would you think about that? Maybe tying it back to
Yeah, no, absolutely. So I think, and again, in terms of the multiplier, I've definitely done studies on the Bitcoin side, which I'll touch on in a second. In terms of the gold side, I haven't done the same level of research, but I have heard Michael Howell talking about this recently, right? He believes that when you look at global liquidity, gold is kind of a 1-to-1 multiplier, or 1.5 or something like that. Whereas when you look at Bitcoin, it's like a 4.5 or a 5x multiplier on global liquidity. And that feels about right. So when I think about inflation adjusting things, the easiest way for me to do this, I divide it by gold. If an asset is not beating gold, in my opinion, gold really is that store of value where you're probably going to preserve your purchasing power and you might get a 30, 40, 50% premium, maybe 2x. That's probably about right. Bitcoin, you get something on the order of a 5, 6x multiplier during good times, right? On the true debasement. How do you measure inflation? It's a very, very hard question because the numbers are all fudged. It depends on what you want to buy. It depends what country you're in, all that kind of stuff, right? The numbers are fake. So there's all these things about how do you measure inflation? Well, gold is, I generally assume, is just like one-to-one with the real currency debasement. And that's the way I like to think about it. Now, it's going to have obviously swings, but that's how I like to look at it. In terms of the Bitcoin world, I see and I wrote a whole piece on this called Dispelling the 118x Multiplier Myth. This is this bullshit piece that Bank of America put out where basically you back calculate it out. It's like, oh, every dollar that goes into Bitcoin creates 118x multiplier. No, it doesn't. And I ran this number. It's like, well, let's actually look at the money coming into Bitcoin. We can look at it via the realized cap and on-chain data and all these things. And I looked at the ETFs. Even if the ETFs are the only source of buy-side demand, and if you pretend that GBTC was not selling, we only got a multiplier of 30x. That's a lot different. That's a lot different to the 118x. So by my estimate, the multiplier of dollars going into Bitcoin, this by the way works both ways. So if a dollar going in, you get a multiplier in one way. If the dollar comes out, you get a multiplier the other way. The highest multiplier I have ever seen, true supply shortage, there are no coins left to buy, is 8x. And it's fleeting, momentary. Most of the time, it tops out about 5x. Generally speaking, it's about 2 to 3x, right? So anyone who's kind of proclaiming a 100x multiplier, read the Dispelling the 118x multiplier myth. I'd be happy to get comments as to why it's wrong. But even if you assume that the ETFs only on the buy side are the only thing driving this thing, you still can't get to a 30x. I struggle to believe it's 100x.
This is a kind of a deeper / funny, theoretical question. But do you think alien civilizations exist? And do you think that they have their own form of Bitcoin if they do happen to exist?
Oh, interesting. I think they have to exist, right? If you just look at the law of big numbers, it's just the probabilities are immense. Bitcoin is an interesting one because at the end of the day, it's such an elegant and simple design that shouldn't work, but it does. And it's one of these really interesting dynamics where it feels like a true piece of novel technology. I don't know how. Again, I can't even begin to theorize. Like, is there a different instantiation of it? Right? We've seen a plethora. Right? How many years has it been? 10 years of people trying to create altcoins. Even if you assume that one of those altcoins launched at was the first asset, I can't see any of them working. I can't see any of them being like the way that Bitcoin has played out. There's so many ways that like governance still exists, and they're technologically challenging, and there's bugs, and it's just they're overly complex, right? Like whenever I look at altcoins and some of the stuff they're doing, I always think about when you travel overseas to like Southeast Asia, you see those telegraph poles, and there's just wires absolutely everywhere. Or you go to Mexico, there's just wires. You're like, that looks like an altcoin, right? Whereas Bitcoin is just this very clean, simple design. Shouldn't work, but it does. Now, whether aliens have kind of found that secret sauce, it's hard to tell, right? Satoshi really put together a bunch of things that already existed, and he put the difficulty adjustment in there, and he just put all the pieces together, right? All the technology existed. So you could argue the aliens probably came to, proof of work, probably something that you would come to. But putting them together into that like final package, in theory, it's achievable. Have they got there? I don't know.
Interesting. Yeah, interesting perspective. 2 more questions, then we can begin to close it out. What's something that you believe that most Bitcoiners would disagree with?
That's a good question. I think that hodlers sell, and I know that they sell. I see it. I can watch it. It puts tops in. Like a lot of Bitcoiners don't believe that people sell. People do sell. It may not be you, but they are selling. So I think that's an easy one. Maybe the dual money standard. Fiat's not going anywhere. I think some Bitcoiners would probably agree with that we're not going to lose fiat currency anywhere, and perhaps that's not the worst thing, right? Having both systems. I just don't see a great deal of governments going full hyper-Bitcoinization. Maybe that's probably the thing a lot of Bitcoiners don't agree with. I don't think that hyper-Bitcoinization is going to play out with Bitcoin as the sole currency of the world. I think that's very improbable. I think that it's very hard to borrow a sound money asset. Look, maybe in 100 years, I think I'll be in the ground before that probably happens. So, I'll leave that for many generations to follow.
Yeah, it's almost better if it happens relatively slowly, even if it does eventually happen. That would be
fully agree with that.
Kind of chaos. Last question. What do you think is the biggest risk to Bitcoin?
Yeah, that's a good one. So I really think that the primary risk, as much as we talked about Bitcoin banks and self-custody, and whilst I believe that 95% of people will not want to self-custody, that's not what I want to happen. That's what I believe is going to happen. I think that maintaining the right to self-custody is of absolutely critical importance. So we need to fight tooth and nail for that. There have been moves to try and ban that, making wallet developers, money transmitters and all these kind of things. I think there's a whole lot of side and back ways that they can make self-custody difficult or, pseudo illegal. That is a very important thing, because at the end of the day, I see a lot of people talking about, oh, look, paper Bitcoin and futures traders and manipulation and blah, blah, blah. We know this happens in the gold market, because if you haven't already gone through the process, try withdrawing your gold. Very, very difficult. It's not an easy process. Bitcoin, we always need to be able to call that bullshit bluff and pull those coins. So I think that's a really, really important element, is being able to call the bluff and pull your own Bitcoin and hold your own keys. Having the opportunity and the right to do that, losing that is a huge risk. And I think there are political movements. And sorry, let me add one more thing to that. I think the other big risk is privacy. We're obviously in a fairly somewhat draconian surveillance state in many parts of the world. Bitcoin doesn't have privacy, and we've actually seen very recently, right, Samurai and Wasabi have shut down and been attacked by the authorities. I think this is also a meaningful risk. I'm somewhat optimistic by some of the stuff that's going on with Lightning and eCash mints and all these types of things. Again, we're very, very early in that process, and that's by no means a silver bullet. But the privacy side is obviously hand in hand with that self-custody. Really, really important. Probably the biggest risk factors I thought privacy is a big risk for a long time.
Yeah, that's definitely fair, and I fully agree with the self-custody aspect. James, thanks so much for taking the time to record. I'm glad we could finally do this. Do you have any closing thoughts, or where people can go learn about more and the work that you're doing?
Yeah, mate, thanks for having me on. Look, I think the thing I'd leave people with is that a lot of people see on-chain data, and they've probably been it got a bit spoiled in 2021. There was a lot of people who didn't quite understand what we were looking at, and that was me included, right? I was still learning what these tools actually did. We now have a whole host of people who've done extraordinary work. I know a lot of guys in every country and nationality and language who are doing fantastic work, right? Understanding what this on-chain data does. For the average hodler, you actually can improve your DCA and be more confident just by looking at what Bitcoin tells us. At the end of the day, what is Bitcoin? It's a database, an append-only database of us making decisions. So what we're doing is we're taking those decisions and then helping it, when lots of people are taking profit, maybe don't buy. When lots of people are capitulating, probably a better time to buy, right? So you can use these simple psychological behaviors to improve your own confidence and kind of navigate the volatility, right? So, that's what we do over at Check on Chain. So we've got a charting website, which is totally free, and also a newsletter, and the way I like to frame it, the charts and the data is free, right? You can get access to those. My time and expertise interpreting it is not. So we basically charge for the newsletter and the interpretation, and we do the charting website, which is totally free. So, you'll find us over at checkonchain.com.
I like it. I like that model. Well, James, thanks again. This has been awesome.
Good on you, mate. Thanks for having me on. Cheers.